What if I told you that a trading theory created more than 130 years ago is still quietly controlling how markets move today, yet most traders completely misunderstand it? Not because it's outdated, but because they're looking at it the wrong way. Most people treat it like it's some kind of rigid system made of lines, patterns, and rules, when in reality, it's a reflection of human behavior. And that misunderstanding is exactly why so many traders struggle, overtrade, and eventually lose money. The truth is, markets don't move because of indicators. They don't move because of fancy strategies or secret setups. Markets move because of people. Every price movement you see is a result of fear, greed, hesitation, confidence, and panic playing out in real time. And if you don't understand that, you're not really trading the market, you're reacting to it. Most traders sit in front of their screens watching small time frames, focusing on every tiny movement as if it means something important. A small spike up feels like a breakout, a quick drop feels like a reversal. But in reality, most of those movements mean absolutely nothing. They are just noise, random fluctuations caused by short-term emotions and liquidity, not real direction. If you step back and look at the market from a broader perspective, something becomes very clear. Trends are not random. They have structure, they have rhythm, and more importantly, they have layers. The market doesn't move in a straight line, and it doesn't move in chaos either. It moves like waves in the ocean. At the highest level, there is the main trend, the dominant direction that carries the market over time. This is where real money is made. This is the movement that institutions follow, the movement that builds wealth. But within that larger move, there are smaller movements going against it temporarily, creating pullbacks and corrections. And within those, there are even smaller fluctuations that look dramatic on lower time frames, but are completely irrelevant in the bigger picture. The problem is that most traders spend all their time focused on those smallest movements. They zoom into the noise and mistake it for opportunity. They think they are catching trends, but they are actually just reacting to randomness. And because of that, they enter trades at the wrong time, exit too early, and constantly feel like the market is unpredictable. But the market is not unpredictable. It just doesn't reward impatience. Another mistake that traders constantly make is believing that every sharp move means something significant. They see price spike up or down and assume that something important just happened. But not all price movements are equal. In fact, one of the most misunderstood concepts in trading is the difference between a wick and a close. A wick is just a reaction. It shows where price went, but not where it was accepted. It represents a moment of imbalance, often driven by stops being triggered or emotions taking over. But a closing price tells a completely different story. It shows where the market agreed to settle. It shows commitment. If price moves aggressively in one direction, but then closes back inside a range, that move wasn't strong. It was rejected. It was tested and failed. But most traders don't see it that way. They see the spike and assume strength, when in reality, it could be weakness. This is where understanding market psychology becomes critical, because once you stop reacting to every movement and start interpreting what those movements actually mean, your entire perspective changes.
Every trend that you see in the market follows a psychological cycle. It doesn't just appear out of nowhere and then disappear randomly. It develops in stages, and each stage reflects the behavior of different types of participants. At the beginning of a trend, nothing looks exciting. Price moves sideways, often within a tight range. There is no clear direction, no strong momentum, and no obvious breakout. Most traders ignore this phase because it feels boring. There's nothing to chase, nothing to react to, and no clear signal telling them to act. But behind the scenes, something very important is happening. This is where experienced participants, often referred to as smart money, begin building positions. They don't rush. They don't chase. They accumulate slowly, quietly, without attracting attention. They understand that real opportunities don't look obvious at the start.
As this process continues, the market eventually begins to move with more clarity. Price starts making stronger moves in one direction, breaking out of its range and attracting attention. Momentum builds. Volume increases, and suddenly it feels like something is finally happening. This is the phase where most traders become interested. The trend becomes visible, and for the first time, they feel confident enough to participate. And interestingly, this is often the phase where they are actually aligned with the market. The direction is clear, the structure is clean, and the opportunities are real. But even within this phase, Patience is still required because the best entries don't come from chasing the move. They come from waiting for the market to pull back. Those temporary moves against the trend, which once looked confusing, now become opportunities. They allow traders to enter with better risk and better positioning. However, as the trend continues, something begins to change. The moves become more aggressive. Price accelerates. Emotions intensify. Confidence turns into overconfidence. And suddenly, everyone is talking about the market. This is where things become dangerous. Because while the public is getting excited, the participants who entered early are doing the opposite. They are not buying anymore. They are slowly exiting their positions. They are taking profits, distributing their holdings, and preparing for the next phase. But to the average trader, everything still looks bullish. Price is still going up. Momentum is still strong. And because of that, they continue to buy, unaware that they are buying from those who are already leaving. This is how most people end up entering at the worst possible time. Eventually, the trend reaches a point where it can no longer sustain itself. But it doesn't just collapse instantly. Instead, it gives subtle signs that something is changing. The structure starts to weaken. The moves become less consistent. And then, at some point, a key level is broken. This is where understanding the difference between a real reversal and a false signal becomes critical. Not every sharp move against a trend means that the trend is over. In many cases, the market will create sudden spikes designed to trigger stops and create confusion. These moves can look dramatic, but they often don't change the overall structure. A real reversal requires more than just a quick move. It requires a clear break in structure, supported by strong momentum and decisive closing behavior. It's not about how far price moves temporarily, but about where it establishes itself afterward. Traders who react too quickly often get caught in these traps. They see a sudden move and assume the trend has changed, only to find themselves on the wrong side when a market continues in its original direction. This is why patience and confirmation are so important. Instead of reacting to every movement, successful traders wait for clarity. They allow the market to show its intention before making decisions. When you bring all of this together, trading becomes much simpler, not easier, but clearer. Instead of constantly searching for signals, you focus on understanding context. Instead of reacting emotionally, you follow structure. You start by identifying the overall direction of the market, not based on small fluctuations, but on meaningful movement over time. You determine whether the market is trending up, trending down, or moving sideways, and you align yourself with that direction. Then, you assess where the market is within its cycle. Is it just beginning to move, gaining momentum, or reaching exhaustion? This context helps you avoid entering too early or too late. After that, you wait. And this is where most traders struggle the most. Waiting feels unproductive. It feels like missing out. But in reality, it is one of the most powerful skills in trading because the best opportunities come to those who are willing to let the market come to them. Once the market provides a clear setup, you look for confirmation, not in the form of indicators, but in the behavior of price itself. Strong closes, clear structure, and alignment with the overall trend. And only then do you execute. This approach may not feel exciting. It doesn't involve constant action or rapid decision-making, but that's exactly why it works, because it removes the emotional chaos that causes most traders to fail. When you look at the common mistakes that traders make, they all come back to the same core issue. They focus on the wrong things. They trade small time frames instead of understanding the bigger picture. They chase moves instead of waiting for opportunities. They react to wicks instead of analyzing closes. They buy when everyone else is excited and sell when everyone else is afraid. And most importantly, they ignore the psychological nature of the market. Because at the end of the day, trading is not about predicting what will happen next. It's about understanding what is happening now. It's about recognizing patterns of behavior, not just patterns on a chart. Once you truly understand that, everything changes. You stop feeling the need to be in every trade. You stop reacting to every movement. You become more selective, more patient, and more consistent. And that's when trading starts to feel different, not because the market has changed, but because you have. So the next time you look at a chart, take a step back and ask yourself a simple question. Are you reacting to noise, or are you following the real structure of the market? Because that one shift in perspective can be the difference between constantly struggling and finally understanding how the market actually works.